The tricks used to manufacture revenue during the .com era appear to be running again, only with updated terminology. Does anyone remember Global Crossing, Q-West, WorldCom? These are the ones we're talking about, but I'm not saying that AI demand is fake. It's the structural question about how revenue is being recognised and whether the circular flow of money between counterparties that are simultaneously investors, customers and lenders constitutes genuine third-party demand. The .com playbook. Firstly, many of us are aware of the vendor financing, lending your customers money to buy your own product. Lucent and Nortel did this with telecom carriers back in the .com time. The same mechanism Nvidia now uses with neoclouds. Friar will talk about capacity swaps, another part of the playbook. Two companies sell each other something neither needs. Both book it as revenue. Both bury the cost. Net economic value, 0. Reported revenue, very real looking on the income statement. Example. Two people writing each other IOUs and declaring themselves wealthy. The income statement looks healthy. However, the underlying cash flow from genuine external customers is what actually matters. The IRU explained. Indefeasible right of use is a long-term lease on fibre optic bandwidth, exclusive rights to a specific route for 20 plus years. It's like owning a reserved lane on a motorway. The legitimate use, Company A has US coverage but not Europe, buys European capacity from Company B. Genuine business need, real independent customer at the end of the chain. What actually happened? Round-trip transactions. A sells $100 million worth to B. B sells $100 million worth back to A. Same day, same quarter, 0 net economic value. Both book $100 million in revenue. The income statement looks real. The demand is manufactured. The critical asymmetry. Revenue recognized immediately. Cost amortized over 20 years. Accountants called this aggressive. Prosecutors called it fraud. Global Crossing and Q-West by the numbers. $720 million. Global Crossing swap generated cash revenues in the first half of 2001 alone, not the full year. 67% of Q-West network revenue in 2001 came from circular swaps with counterparties. Congressional hearings confirmed through internal documents and emails. The sales teams, not the network engineers, were driving these transactions. Engineers kept asking why they needed the capacity. Answer: they didn't. The $515 million Q2 2001 swing. Global Crossing reported $472 million recurring adjusted EBITDA. Without swap transactions, negative $43 million. That is not a rounding error. The entire reported profitability was manufactured by a round-trip deals with 0 net economic value. Q-West's SEC total, $3.8 billion in fraudulent revenue between 1999 and 2002. When Q West's president testified before Congress, he described exposure as 2 to 3.5% of revenues. He misled Congress. The actual number was $3.8 billion. Now, options implications. Revenue restatements of this magnitude are not priced in gradually. They arrive as a step function, discontinuities. Theta decay is your enemy on bear positions if timing is wrong, but the payoff when the restatement hit is violent. This is why the structure matters. It's not a short-term trade. How they cooked the books. Side agreements. To front-load revenue, capacity had to be route-specific, not portable. If portable, it was an operating lease. No front-loaded revenue. Q West's solution: write compliant contracts on paper, then make oral side agreements granting flexibility. Auditors saw the written contract only. Result: $550 million revenue restatement when discovered. Invented metrics. GAAP limited Global Crossing to $1 million per year on a $20 million 20-year IRU. Cash was in the bank, non-refundable, but not GAAP revenue yet. Solution: create cash revenue and adjusted EBITDA, including full upfront swap cash. In Q2 2001, these metrics inflated reported earnings by about 50%. Chairwoman Sue Kelly's observation from the March 2002 hearing: pro forma statements provided an easy opportunity to cook the books. The pro forma statements were not required to follow GAAP, which is precisely why they were useful. Now, an important note. The executive email is the most damning primary source. Approved $70 million in capacity purchases. What the hell are we going to buy? That is not a demand problem. That is a Wall Street narrative problem. The gap between projected and actual revenue determined the size of the swap, not the other way round. Q West employees' own internal terminology: heroin, cocaine on steroids. They called it an addiction. They knew the books were being cooked. Returning to Fry's Peter and the Wolf principle. March 2002, before the House Committee on Energy and Commerce, WorldCom's General Counsel testified under oath that WorldCom does not participate in such transactions, specifically by name distancing from Global Crossing and Q West. WorldCom collapsed months later, $11 billion accounting fraud, the largest in US history at that time. The lesson is not that all denials are lies. The lesson is that the volume and specificity of unprompted denial is an informative signal. A company that sits at the witness table and preemptively names competitors it is unlike has revealed something about its own anxiety. Peter and the Wolf concept runs through Fry's macro framework. Repeated declarations of resolution with no structural settlement erode credibility exponentially. Applies equally to ceasefire narratives, earnings guidance that consistently prove overly optimistic, and management teams who preempt questions about revenue quality with unprompted assurances. So always watch for unprompted specific denials in earnings calls and congressional testimony. These are tells, not reassurances. We'll run through the AI boom translation table. So the purpose is not to claim AI companies are committing fraud. Rather, it's to ask whether the accounting logic is equivalent, even if legal treatment differs. IRU, cloud credit. Same long-term prepaid commitment structure, same front-loaded revenue recognition question. Global crossing, cash revenue, RPO contracted backlog, non-GAAP metrics, blending binding and non-binding commitments into single numbers that always go up. Enron Broadband, CoreWeave, a related entity created specifically to facilitate the circular flow. Vendor financing, Lucent and Nortel. NVIDIA, equity investment in NeoClouds. Supplier finances customer to buy supplier's own product. Oral side agreements, non-binding commitments in backlog metrics. The number looks committed, the legal obligation is not. Again, Friar's not claiming fraud. It's purely the question of arm's length commercial reality versus circular ecosystem accounting. The DotCom parallel makes us question this. Now an example, NVIDIA NeoCloud circular loop. So NVIDIA invests equity in CoreWeave. CoreWeave uses that capital to buy NVIDIA GPUs. NVIDIA books the GPU sales as revenue. NVIDIA signs a contract to lease compute back from CoreWeave, paying for access to the very GPUs it just sold them. CoreWeave CEO Intrador stated publicly that NVIDIA fully underwrites the economics. That is not an arm's length commercial relationship. That is a company special purpose vehicle relationship with equity characteristics, very similar to Enron's off-balance sheet SPVs. $26 billion number. NVIDIA holds $26 billion in cloud credit commitments as of the 30th of September 2025. Anticipated Q4 usage, $1 billion. At that burn rate, 26 quarters to consume existing commitments without new deals, the 206% quarter-on-quarter growth in multi-year cloud service agreements is management's answer to the question. However, the question remains, are those new agreements with the independent third parties or more circular commitments within the same ecosystem? So looking at options positioning, NVIDIA's $26 billion in cloud credits is a contingent liability dressed as demand. Hence, Friar's QQQ January $560 put leap, January 2027, already in place and awaiting entry on SOX bear put spread leap, and also the EWY, the South Korea COPSI index, waiting for entry. The full ecosystem map. So this slide makes the systematic point explicit. Every arrow in the AI ecosystem. NVIDIA sells GPUs to Microsoft, Google, Amazon, Meta, CoreWeave, Lambda. Microsoft selling Azure to Meta, Google selling cloud to enterprise customers who include Amazon subsidiaries, Meta buying cloud from Microsoft while Microsoft integrates Meta's LLAMA. creates a receivable on one side and a payable on the other. The gross revenue problem. Analysts and investors sum NVIDIA's revenue plus Microsoft Azure plus AWS plus Google Cloud plus CoreWeave's revenue. But the net economic activity is substantially smaller because so much revenue is flowing between participants in the same loop. Gross revenue across a circular ecosystem overstates net external demand by construction intentionally. SMCI. Supermicrocomputer sits in the middle as a pass-through assembler. Accounts payable up 1,074%. Buying components from NVIDIA. Accounts receivable up 435%. Selling assembled servers to a mystery customer A whose identity is not publicly disclosed. If customer A is a neocloud or a hyperscaler, that in itself is a circular flow. Then SMCI's balance sheet distortion is an intermediary version of exactly what's happening at NVIDIA and CoreWeave level. Friar, looking at it, always ask, who is the independent third-party customer at the end of the chain? If it's not publicly disclosed, immediately consider it's dodgy. If the answer, another participant in the ecosystem who is also a supplier and investor, you have a circular structure, not organic demand, dodgy. The 2008 parallel, gross versus net. This is the most structurally important analytical parallel. The 2008 crisis was not simply subprime mortgage defaults. It was the unwinding of a gross balance sheet structure that massively exceeded the underlying net external cash flow. Net external cash flow, homeowner mortgage payments. Banks were lending to each other, buying each other's mortgage-backed securities and carrying receivables and payables from each other simultaneously. The gross balance sheets looked enormous. The gross revenues looked enormous. But the net exposure was actually external borrowers was a fraction of what gross figures suggested. When external cash flow proved insufficient, the entire cross-obligation structure unwound simultaneously. The AI parallel is structural, not superficial. NVIDIA, Microsoft, Google, Amazon, CoreWeave, and other associated entities are buying, selling, and backstopping each other simultaneously. Gross revenue across the ecosystem is additive in analysts' models. Net external demand, enterprises and consumers actually paying for AI services that generate revenues, is the number that matters, is far smaller, and that is Friar's opening. Key risk. When circular structures unwind, they unwind together, not sequentially. The 2008 transmission mechanism was that cross-institution exposures meant no single institution could be isolated. The AI ecosystem has the same property. A NVIDIA restatement, a CoreWeave covenant breach, a hyperscaler CapEx cut, any of these propagates across all counterparties simultaneously. Again, Friar points out, helium shortage. In fact, very little helium. SMCI, the ecosystem's visible symptom. SMCI is the most analytically interesting company in the ecosystem precisely because it is a pass-through with thin margins. It has no cushion to absorb timing mismatches between its payables to NVIDIA for components and its receivables from customer A for assembled servers. Accounts payable at a 1,074% increase is exploding because SMCI is buying components from NVIDIA at pace. This reflects the pace of GPU orders flowing through the ecosystem. 435% increase in accounts receivable is exploding because the mystery customer A, likely a neocloud or hyperscaler, is ordering servers, but payment terms are extended. This is the circular loop made visible on the balance sheet. At 6.3% net margin, any timing mismatch, delayed payment from customer A, or a pause in orders creates an immediately liquidity problem for SMCI. This is why it serves as an ecosystem canary. It has no buffer. It sits directly in the flow between NVIDIA, supplier, and the circular loop participants, customers. Thus, monitor SMCI's accounts receivable and accounts payable ratio and days sales outstanding as leading indicators of circular loop health. If customer A slows payments or cancel orders, SMCI reports first. And if there are no chips being made because of the helium issue, they're all going to be reporting badly. The 4 key questions. Question 1, the NVIDIA CoreWeave loop. Is this an arm's length transaction? A capacity swap with equity characteristics? A company special purpose vehicle structure? Or all three simultaneously? The question is not rhetorical. The legal and accounting treatment differs depending on the answer, and NVIDIA's reported revenue depends on which classification applies. Question 2. The hyperscaler backstop. Signing a multi-billion-dollar commitment with a neocloud while simultaneously backstopping its debt facility is not arm's-length commercial behavior. It is a mechanism to move CapEx off the hyperscaler's balance sheet while retaining effective control. This is off-balance sheet financing by another name. Question 3. Non-binding commitments as revenue. AI lab commitments, many are non-binding, flow into RPO lines and neocloud revenue projections. Everyone in the ecosystem points to everyone else's numbers as proof demand is real. This is the circular cartel accounting structure of the DotCom, updated for 1926. The legal treatment differs, the economic substance is comparable. Question 4, the metrics question. RPO, annualized run rate, contracted backlog, all blend binding and non-binding, real and projected, current and aspirational into a single number that always goes up. The structural function is identical to Global Crossing's cash revenue. Preset the number that shows growth, defer gap reckoning. Trading implications. Friar's framework. Revenue quality degrades before price. The dot-com bust did not begin when fraud was proven. It began when growth narratives stalled and invented metrics could no longer paper over the gap. So watch for gap revenue growth decelerating while non-gap RPO metrics stay elevated. That spread widening between the gap shows and what management claims. This is the tell. It preceded the dot-com collapse by quarters. Correlated ecosystem equals correlated collapse. the planned SOX bear put spread, which is for January 2027, and the QQQ January 27 $560 put leap, which is already in place, are structural. They're justified by this analysis. NVIDIA, CoreWeave, hyperscalers and AI labs backstopping each other's metrics are correlated on the downside. This is not a single name risk, it is a sector-wide structural risk that justifies defined risk spread structures rather than naked positions. 2008 parallel. Watch the net, not the gross. Analyst models summing sector revenues double count circular flows. This relevant number is net external demand from genuine third-party customers. Build your own rough estimate by looking at enterprise AI spend from genuinely independent corporates and compare to the ecosystem gross revenue claims. The gap is the structural vulnerability. SMCI as the ecosystem canary. Monitor SMCI's AR and AP ratio, the days sales outstanding alongside the algorithm's signal output. The deterioration in SMCI's receivables quality or the accounts payable, accounts receivable ratio reversal before the algorithm fires provides early confirmation of loop stress. And wait for the signal. This deck is structural context, not a timing trigger. The thesis may take quarters to resolve. The doctrine remains unchanged, as does the thesis. We wait for the signal. Okay, to finish up with, the product has changed, the mechanism has not. The progression, fiber to GPU, IRU to cloud credit, cash revenue to RPO, global crossing to CoreWeave, Enron broadband to SMCI. The actors changed, the circular flow of money, the dependency, the accounting engineering has stayed the same. The .com bust did not begin when fraud was proven. It began when the growth narrative stalled. For AI, the question is not whether AI demand exists in aggregate. It clearly does. The question is whether the specific transactions being used to book that demand reflect genuine arm's-length customers at the end of the chain, or a circular ecosystem where supplier, buyer and financer are all the same entities. When the net external cash flow, the genuine enterprise and consumer AI spend generating real returns proves insufficient to sustain the gross cross-obligation structure, the whole thing unwinds together and fast. And again, this does not include the helium, bromine, etc. issues. Good day.